All right, welcome everyone. Today we have Nichole as our guest speaker. I will let her introduce herself, but we're going to be talking all about how the wealthy avoid taxes and legal tax tips. So I am very excited to let her take it away.
Good afternoon, everybody. Today, thank you, Annie, for your introduction. I am super excited to be here today. We're going to talk about how to avoid taxes. We just finished tax season, and if you're like me, that is a dreaded time of the year, or how I used to be. I'm no longer like that, and today I'm going to explain kind of why. Uh, And I'm not using presenter mode, so bear with me, you guys, as we go to the different slides. So again, my name is Nichole. I'm an attorney, professional speaker, author, certified tax advisor, an entrepreneur with an MBA in entrepreneurship, and a business advisor. And I go by just Nichole, to not confuse. I just recently got married. So if you look me up under anything, it's going to say Nichole Compton. But my name is Nichole Shelton officially. I just have not had the opportunity to change it. Well, to change it on all my SEO stuff. But Nichole is what everyone calls me. So that's what I expect you guys to know me by. I eat, breathe, and sleep entrepreneurship and business and saving money. I want you all to understand some of the things that I've learned over the years. I've been fortunate to have either presented for or worked with these companies and more. I work with entrepreneurs and small business owners, especially when I do business and legal courses or representation, advising, and tax planning. So I'm a US based attorney. My practice, I have two businesses, one for coaching and consulting and one the law firm, but both are dedicated to serving small businesses, trying to help people to reduce their taxes, to reduce their expenses. And tax is your number one expense that you will ever have. And then to maximize their profits and know when they make the money, what to do with them. So I use my extensive experience in law and business and what I've seen go wrong with others and myself over the years to help people to avoid those and be able to explain the confusing, sometimes confusing, but usually complex ideas that come with law and taxes. So when I've already said that I'm an attorney, when most people think about attorneys, you think about somebody who's rolling in the dough and who's rich, not rich enough, like not yet. My family members think, oh, she goes to court every day. She puts on a suit and walks out with a briefcase. That's not really what I do, although that was at one point in my life and career how I live. But honestly, it's a lot of paperwork and a lot of work and a lot of distilling complex information to be able to help my clients. So I always like that meme, so I figured I would share it. I always have to give a disclaimer when I do these kind of presentations. So I am an attorney, but I'm not your attorney. So this presentation is intended strictly for educational purposes and a little bit of entertainment because I like to throw my pizzazz, your sister girl in the law, pizzazz on things. But what I'm telling you, I stand behind. I do always say that I don't know everything, but I know what I know. I know what I don't know, and I know how to find out what I need to know. And that's important. Any attorney who tells you otherwise, run the other way. This, just because you attended today, or if you stay to the end and get my freebie, that does not constitute an attorney-client relationship or attorney-client privileges. If you do want me to become your attorney, we have to meet and sign a contract and agree to form that relationship. And I'm open to that. That's just not what we're here for today. So let's get started and talk about saving money. Before we do, I also want to give my DIY philosophy. So attorneys are professionals with professional degrees. just like you have a doctor in the law, a doctor in medicine, an MD, or you have a dental doctor, a dentist, you're a DMD. Attorneys are juris doctors or have a doctorate in law. And so when you hurt yourself, so I'm raising my grandson, and if he trips and falls and he hurts his knee, Nana's gonna kiss it. I'm gonna clean up the boo boo. I'm gonna put a band aid on it. If he breaks his leg, I am not trying to reset that bone. And I'm definitely, if he needs if he needs an appendectomy, I'm not doing that either. Same thing with being a dentist. You know, if his tooth gets loose, which they are frequently nowadays, he sees that as his opportunity to make money. So miraculously, all of his teeth have been getting loose here lately. But if his tooth is loose, you know, I may pull it out for him or tie a string around it, you know, like they used to do in the old days. But if he needs a dental implant or a root canal, I know that that is way above my pay grade. I'm not doing it. Law is the same way. There are certain things in law and tax planning that you can do for yourself. So, my goal is to let you know what those things are, or at least to give you enough knowledge for you to continue your research so that when you or if you hire a professional tax advisor or an attorney to help you with this, you can have an intelligent conversation and be able to advocate for yourself and kind of know going in what it is you want to do. But many of these things that I'm going to tell you, you can implement for yourself. So that's my philosophy on doing it yourself. A little housekeeping. If you have questions, then I am more than happy to answer them. If it is a personal question, I don't mind staying to the end when everybody's gone to answer those for you, or I can tell you how to contact me to set up a one-on-one or a consultation. But I do like interaction. So don't feel like you're bugging me if you have a question and you want to stop me. I may not see the chat. So Annie, if someone has a question that I'm missing, feel free to hop in, take yourself off mute, ask me the question. It won't bother me. It actually is encouraging. That lets me know that you're paying attention. And if you have a question, I almost guarantee you somebody else has a question too. So don't be scared to ask. Get prepared, get your paper, get your pencil, because you're going to want to take notes on these nuggets that I'm giving you. And I promised you 7 tax strategies that the wealthy use to avoid taxes, but there may be a couple of bonus ones towards the end. So if we have enough time, I'm going to make sure that I cover the 7 and give you a few extras. So the old adage goes that there are 2 certainties in life, that is death and that you're going to have to pay taxes. But what if I told you that's only half of the story? That's only half true. Because while death is indeed inevitable, because we're all going to die one day, the amount of taxes that you have to pay, those are actually negotiable. The wealthy for years have been using the law as it's written to pay less or no taxes legally. Let that sink in. No taxes are less legally. Now, as a tax advisor and an attorney and all of the things that I've been doing for the last 20, 25 years, I've worked with solo entrepreneurs as well as worked with Fortune 100 companies in some capacity. And the thing that I've discovered is the ultra wealthy aren't just paying no taxes or little taxes. They definitely aren't paying their fair share of taxes, but it is 100% legal what they do. In fact, the tax code is written for everyone. The sad part about it, like my tax professor said in law school, is that because it's written, no one follows it. If it was freely put on social media or on TV, we may listen, but to actually go through the tax code, which is huge, and figure this stuff out, people just don't. However, the wealthy have talked to their congressmen. They've pulled their, I'll say pull their weight because I believe they pull their weight to make sure that the tax code is written to benefit them. And then they hire people to make sure that it's implemented. But there are no loopholes in the tax code, I assure you. Everything that was literally written in there was meant to be there. It's our job to go in and find it. And if you do, you will be rewarded with strategies on how you can save taxes like the wealthy. So let's learn these strategies so we can reduce ours. Warren Buffett, he famously said that he pays less taxes than his receptionist or his secretary. That's crazy. Jeff Bezos, for years, bragged about how he pays zero federal income taxes, and we can't even get started on Elon. I think he paid taxes at one point just to shut people up, but didn't have to. Billionaires actually pay less in their taxes than their assistants in this world. And it's not necessarily, like I said, because they're cheating the system. They just understand the system. And they have a different mindset when it comes to money and how to figure these strategies out and how to implement them. And so the first thing that I know in comparing what I see with even just so wealthy clients that I have, not even the ultra wealthy, the Jeff Bezos and the Elon Musk of the world, but wealthier clients. I've looked at how they kind of move through the world and how they handle their affairs. And then the everyday average person, like my mom, my dad, or my neighbor down the street. The first thing that sticks out when it comes to anything that has to do with wealth, number one is mindset. The thing is, we have all been programmed to think about taxes completely the wrong way. So I'm going to tell you about a few of my clients. I promise you that I will change the names so that I don't divulge anything or you can't figure out who it is. So don't even try. But I'm going to tell you about a couple of my clients as we go. The first one that I'm going to tell you about is Sarah. Sarah was making about $300,000 a year. She comes to me close to tax time, but before, and says, I think I'm gonna owe 40,000 in taxes. What do I need to do to get out of this? Then another client, on the other hand, we'll call him Michael, comes to me and he calls closer to the beginning of the year, like in January, February, and he says, okay, Nichole, I think I'm going to make $300,000 this year. I need to know what I need to do to structure my business in a way that I can keep as much of it as possible because I don't want to pay the IRS. Cool. Now, my thought on this, and I say it every time I teach on this, is that if you make a little bit of money, then the government wants their portion of your little bit of money. If you make a little bit more, they want a little bit more. If you make a lot, they want even more. But if you are ultra wealthy or smart, they'll walk away. They'll leave you alone. The ultra wealthy, I think, is more because of their mindset and how they do things, not just because of their position in the world. And so you can get there too. So, in having that conversation with Michael and Sarah, the conversation was about the same. Their income was the same, but how they thought about this and approached it was two totally different ways. Because Sarah, she was playing defense. She was trying to figure out how to minimize the damage, and it was after the fact. It's too close, in March or April to come to me with a box of receipts and say, "Now fix it." Now, can I? Yes. Did I? Yes. Was I able to tell her do this and pivot here and make sure that, you don't forget to take these certain deductions? I was able to do that. But Michael was so much more in a better place because he was playing offense. He was actually looking to design a wealth building strategy from the beginning. So guess who paid less in taxes? It was Michael. He pays significantly less, almost $20,000 less than Sarah. Same income, $20,000 difference to the bottom line. And I don't know about you, but $20,000 is life-changing money to a lot of people. And it's definitely something that I wouldn't, that I wouldn't laugh at because I could do so much with 20,000. And it wasn't luck, it was because his mindset was different and he had strategy. Many times I have clients that show up and they have a bunch of money and they're so focused on tax is a bad thing, not tax is a cost of doing business. And so I think mindset number one of the ultra wealthy, they don't think about taxes and preparing for taxes like we do. They don't care about the they don't care about the after fact or the liability afterwards because they've already thought ahead of time at planning and preparing, not paying and being surprised. And they're also not looking for refunds. This is a freebie. If you are looking for your refund at the end of the year, is very sad for you because that means you just gave the IRS a free loan where they made money with your money. You got no interest, and that money could have been in your pocket. A person who has a great tax plan and has worked with a professional planner, the goal is really to get it as close to zero owed as possible. That means you kept that money in your pocket the whole year and you were able to use it instead of letting them save it up for you, borrow your money and then give it back to you, give it back to you after you paid your taxes like you got a gift from them when really they were the ones who benefited. So instead of thinking about the aftermath, let's get smart, change our mindset to being more proactive, not reactive, and strategic. So the first step is the mind shift. Now, strategies. I know we talked about the mind shift. Strategy number one that I noticed that the ultra wealthy use is the buy, borrow, die. My BBD method. Buy, borrow, and die. So this strategy is one that I still grapple with because it sounds a bit morbid and it sounds counterintuitive, but stick with me because this is probably one of the most powerful ways that the wealthy build their money. The first thing, well, let me give you an example. We'll call this guy Rob or Robert. So Rob is a techie. He's a tech entrepreneur who started his own company. He's got millions of dollars, maybe 50 million. Now, if Robert was thinking like most people, then he would want to sell whatever stock he had and then pay his capital gains taxes, which could be about 10 million, and then live off the remaining 40 million because hey, when you got 50, what's 10? But 10 million is still a lot of money. So instead of doing that, Robert thinks differently. He thinks more like a wealthy person. So instead of selling and triggering a huge tax bill, instead Rob could keep his stock, not sell it, but then borrow against the 2 million for a small amount of interest. So he would basically borrow against it. The loan could have, let's say, a 2% or 2.5% interest rate as he pays it back. Instead of taking a $10 million tax hit, if he borrows against the 2.5, borrows against the 10 million that he has, or takes out the 2 million, sorry, takes out the 2 million, borrows against that at 2.5, then that means 2 million of his money became not taxable because it was a loan. So he kept that part. He got the loan and zero taxes are owed on that 2 million. Meanwhile, he still has the 10 million he would have lost in capital gains in his $50 million account. And that $50 million worth of stock continuously grows until it grows at a much higher rate. So let's say 7 or 8% annually. You can even go down to 5. I would much rather him do that and have the 5% growth on the 50 million, it makes the 2.5% interest rate that he's paying on the 2 million very insignificant. So basically what he's doing is he's keeping all of his money. He's keeping all of his assets. He's not taking the tax hit. Now, this is the morbid part, but also the beautiful part. If he passes away, and not today, but let's say he keeps his stock for the next 10, 20 years because he's older, his beneficiaries, his heirs can inherit that stock on what's called a stepped up basis. So whereas if he was going to pay the capital gains on the 50 and it comes out to the 10 with the stepped up basis, whatever money that he grew, remember when it was, he left it in there and it was growing at the 5, 7, or 8%, whatever money it grew, his heirs get the money and take it out and they want to cash it out, then they would have, in a different scenario, they would have to pay all the taxes on it. So if he took it out, he'd have to pay taxes on it when he took it out because he left it in there. His heirs, when they get it, they don't have to pay taxes on it. And it's as if it goes, the amount of money that was earned goes back to zero because they are assessed on whatever that stepped up basis is. And I get excited at this and I have all my charts and stuff, but because we only have an hour, I can't show you on a chart as well as I can if we have more time. But think about it like this. Your grandmother bought some Apple stock back in the day when it was $10 a share. She dies. Now the shares are worth, let's say, 1,000. I'm just pulling it out the air. You then inherit that $1,000. It's no longer $10. So if you sell it the next day for $1,000, you don't have the $990 gain that grandma would have had. You have no gain because you got it at 1,000. And if you sell it at 1,000, you pay zero. So all that appreciation over time, all of that money and wealth that he accumulated while he was living, he didn't have to pay anything on it, and neither does his heirs. And if they leave it on there and they leave it for their heirs, then it becomes tax free. Becomes tax free forever if you do it a certain way. And so you have to, there are things that you need to do, and there's time frames, like there's limits on how many years you can let it sit before you start realizing. And but there's ways to do it to where essentially you can do that forever. So Dave Ramsey, God bless his soul, I love him. He teaches about wealth and being debt free, but he does it for the average person who was trained to look at taxes as a bad thing because they were looking at the aftermath and they weren't planning ahead so that they don't. I believe in what he does. I've used his methods to get out of debt. I've preached it to others. I've bought my son the envelope system, all of that. But as I got older, I realized my mindset needed to shift. I wanted to start thinking more like Robert than what Dave Ramsey had taught. Part of that is because in this one, when you buy, borrow, and die, essentially, if you look at it, they're living on debt. They're living on debt. They're not touching the assets and everything that they borrow. They're living on what they borrow, but then you can borrow and borrow and borrow, all while your original asset continues to grow and appreciate in value. So I know that you're thinking 50 million. I wish I was Robert. I'm not a techie. I couldn't sell I don't have that much in stocks. What, Nikki, how does this work for me? Here's how this applies to you. Any appreciating asset can be used this way. Now, I don't recommend doing it with your home, but I've seen people who have done it with their home. In that instance, my opinion is that you pay the home off. You pay the home off, you have that as an asset, and you don't use the equity or you don't use the equity before you pay it off and fully own it to do anything that doesn't bring us a huge return. However, I've had clients who have taken out, the second mortgage to start their business or to invest in something. And sometimes it works out, not always. But there are other types of assets that you can use. So any appreciated asset can be used this way. But let's say that you have an investment account. Maybe your investment account has 20,000, or maybe it has 200,000 in those accounts. Instead of selling those investments to get a car or take that trip you wanted or to fund your next business venture, consider borrowing against it. Get a low interest rate when you borrow it. So essentially, make sure that whatever you're borrowing it for, that your interest that are your the amount of money that your return on investment brings is greater than your loan amount. So real world example, and then we'll move on to the next one. Because I had a client exactly who did this one. Um, she needed to get some money to launch her new business. She was a coach and she wanted to have an online course, and it took all of this stuff to get it together, right? Instead of cashing out her retirement account and paying the penalties and taxes because she took money out of her retirement, she was able to get a securities-backed loan. It was less than 3%, and her investments kept growing. They kept growing at 9% while she was paying the 3%. So she had a 6% swing on what she was able to do with that money. Now, I said retirement accounts are a little bit different than homes, but you still want to be careful and you want to make the right decision. With the planning, she was able to make her money back and still avoid the taxes. So the key principle here is you never want to sell appreciating assets if you can use them to borrow against instead. Now, I talked about my last client wanting to start a business. One,
Nichole,
yep.
just super quick before you move on, I'm curious, just because I can imagine people are probably wondering, when it comes to borrowing against your assets, what types of loans do you recommend? Where are people getting these loans at 2 and 3%?
So different places. So with, let's say if you have stocks, you can take out a margin loan depending on who your brokerage firm is with, who you have your stock portfolio with. So in that case, that's who you look. You can shop around for many of these. It depends on what you're gonna do with the money and how the loan or if the loan is secured. So if you have a great personal credit score or you are doing this for your business and you've been in business for a while, then you may have a lot more opportunities than someone who doesn't. So it really depends on what you're going to use the loan for, and which asset you're using.
Okay, that's super
Does that
helpful. Thank you.
answer? Okay.
Yeah.
All right, so I guess I really, this could have been the whole class. My number one thing that I know about wealth building is you are almost never get wealthy with a 9 to 5 working for somebody else. One of the reasons I love entrepreneurship is sky's the limit. I'm my own limitation when it comes to making money. How much time do I want to spend? Does spending extra time working, does that suit my lifestyle? What do I consider my own success? What am I good at? What are the things that I want to do to make my money, and how am I going to make it, and what I have to offer? That's my limitation. A 9 to 5, you are at the whim of someone else. And I know in it, like if you go to buy a house and you're an entrepreneur, there's extra hoops that you have to jump through if you're self-employed. However, I think that's backwards because a self-employed person knows how to sustain and be creative. And again, you're your own limitation. I've actually had clients that I've had to represent against major corporations because they came to work and there was no paycheck. Like I worked and paychecks come out on Thursday and it's now Friday or it's now next week and the money wasn't there, or the check. I've even had clients where the check bounced or the office shut their doors. Then can you get your money? Do they owe you those wages? Yes, but you're at their mercy. And just because you get a paycheck doesn't mean you're guaranteed to always get a paycheck. However, entrepreneurs, you're the one that's in control. So if you're an entrepreneur, however, there are different ways that you can structure your business. You can hang your shingle tomorrow and say, hey, I'm in business today. And voila, you have a business. And the IRS will be happy to take their portion of what you made. If you, most people start an LLC, and an LLC is great to get started with. I usually recommend, doing, not forming an LLC until you're sure and you're really, gonna be up and running. Investing in starting an LLC once you are really up and running so that you can get the protections and the legitimacy or the credibility that comes with having an LLC and being a real business. But once you start making money, you really want to consider how is your business structured and if it's going to help you. And one of the number one business structures that saves individuals and working families money is to have an S corp. So an S corp is where most businesses or business owners leave a bunch of money on the table. As an LLC, and I can teach a whole class on that, but as an LLC, it's what's considered a pass-through entity. So originally, the government, you either had a sole proprietorship where you were unorganized or unincorporated, or you had a corporation. And then, those were your two things that you could really choose from. So you were going to be unincorporated or you were a corporation. Years down the road, states came out with a new type of entity called the limited liability company. And the limited liability company basically says you're not a sole proprietor. So you didn't just hang your shingle, but it gave you a little bit more formality. But the but you could act as a corporation in ways. So it's almost like an LLC and a corporation had a baby. Why that matters, I skipped this step. With the sole proprietorship where you just hang your shingle and you start working, that all of the income, the income and the tax liability go directly on your 1040 tax return, even though your business is separate and apart from you, it's still that's your money goes on your return. The same thing with LLC, because the federal government didn't create LLCs, they look at those and say, oh, that's cute, and call it a disregarded entity. Like that's not one of ours. So, we don't know what that is. So you're taxed as a sole proprietor unless you opt into being taxed as something else. And so the corporations, when they get taxed, corporations are standalone entities. They get taxed, and then their owners or shareholders, they get taxed too. An LLC and a corporation coming together make an S corp, and I can go into it more, but for the sake of time, I won't. But that is strategy number 2. It helps to avoid self-employment taxes on distributions that are made to the owners or the members, and it's also set up to where you pay yourself as the owner a reasonable salary, and that's a whole nother thing. And then you take distributions on the rest. Now, why that matters and how that ends up saving you or costing you, let me explain with another example. So we'll call her Maria. So let me tell you about Maria. Maria is making, let's say, 200,000 a year. She's set up as a sole proprietorship, which means she didn't become an LLC or anything. Or maybe she did. We'll say she did. Let's say she did. Because they're tax-wise, they're treated about the same. tax-wise. So she ends up paying self-employment tax on the whole $200,000 that she makes every year. Self-employment tax is, and I don't have my chart in front of me, it changes yearly, so forgive me. I'm gonna say like 16%. So she's paying that 15 or 16% on 200,000, which is about 30,000. But in addition to paying that, she still owes income taxes. So when you have a job and your employer gives you your check, or your at the end of the year your W-2, if you notice, they take out taxes out of your paycheck, and then they add taxes that they pay taxes almost equal to what you're paying. So the IRS is getting it from the corporation and is getting it from the employee. But with Maria being an LLC, which is a straight pass-through entity, or a sole proprietor who's done nothing, she bears not only the self-employment tax, but they still want like FICA and Social Security tax, all of that stuff. She still has to pay what she would have had to, what the corporation and the employee would have had to pay on that salary. So instead, if she's an S corp, she would pay herself a reasonable salary, let's say $80,000 for the work that she does. But remember, she's making 200. So she only pays the self-employment taxes on the 80%. And actually, self-employment taxes are more like, it comes out to be more like 25 to 27, depending on where you're at. But she was a higher bracket, so could have been less. Um, anyway, so she ends up as an S corp saving almost $20,000 a year in the self-employment taxes. Now the rest of it comes through as an owner distribution and not wages. And thanks to some laws, the wages for the tax liability for a corporation is a lot less, and sometimes comparable to what self-employment taxes are. So she's paying on the 80,000 reasonable salary, she's paying the higher tax amount. And then for the 120,000 that comes through as a distribution, she's paying a lesser amount. So the magic of it all is that she's saving money. She's saving money. And if you're netting 40 to 50K a year with your business, you should really consider being an S corp for this reason. The other part that also makes it great is, as an S corp, what she would get that she wouldn't get as a sole proprietor is that she can deduct things like health insurance premiums if she's paying for herself, which are big if you're self-employed. She can do great things with like her retirement contributions and how much she puts in for that, and setting up her own accounts. And she still gets all the write-offs that she would get, like the business expenses and the operating expenses that would be limited otherwise. She can take those deductions that are only available to S corps or corporations. So with that, she's able to put in way more money into her pocket, or to reinvest it in things that are going to grow her money. And every year, if she has a set reasonable salary, then that means every year her salary can be 80,000. And if her business makes 500,000 next year, but her reasonable salary is 80, that 420,000 now is taxed at the corporate rate, which saves, again, not the corporate rate, at the other rate, which saves her money. So the key to all of this is that if you are going to be an S corp, you want to make it your election early, although there is a way to look back like almost 3 years with it. But if you're going to do it, talk to an attorney or a tax advisor on the best time to do it, so that you don't miss the deadline and you're not stuck waiting a whole nother year to take advantage of this, because this is a whopping big savings. And I got a calculator where you can put in, this is how much my business makes, what is my reasonable salary, and it helps you figure it out. You put that in and it'll show you what the differences are. Strategy number 3. Strategy number 3 is to be a charitable giver. To be a giver. Imagine that. So we look at, Bill and Melinda Gates and, other like the Walmart Foundation and all of that and think, oh my God, they have they're so giving, or they have these grants, when really it isn't even about just being generous. And I'm not saying that they're not, but it's not about that. The giving is actually maximizing their tax benefit and decreasing their liability. So, like, I use a friend of mine, and we'll call her Charity just because we're talking about charitable giving. So, Charity's a business owner. She wanted to donate 25K to her favorite charity. She was into dog rescues. So she wanted to donate to this dog rescue charity. Now, the regular accountant told her just write a check and take the deduction. But there was a better way. Instead of doing that, Jennifer, instead of doing that, Charity was able to donate $25,000 worth of stock that she had. She'd only bought the stock for 10,000. So she had a basis of 15. It appreciated 15K, but she was able to avoid paying capital gains tax with that, which would have been on the 15%, the $15,000 profit. That ended up saving her about 3,000 in taxes. So she couldn't deduct the whole 25, but she ended up with a total tax savings of about 9, which would have been less the other way. So her 25K donation really cost her only about 16,000 out of pocket, but she really realized the 25K. If you look at it just a little bit further though, Jennifer could also set up what's called a donor advised fund. And that's almost like her charity checking account. So she can contribute money or stock. So let's say she put in stock into this donor advised fund all at once. And then she's got the full deduction immediately. That saves her about $37,000 for the year. And so she doesn't have to decide where she wants to donate the money right away. She can let it sit as long as she does donate it. And so the money grows tax-free in that fund. And then when she's ready to help the dog society or whatever, or she wants to donate to her church or pay her tithes and offering, then she's able to control who she's giving it to and when she's giving it to, but she's already reaping the benefit in the taxes. So that strategy ends up being really perfect for business owners, especially if you are in a high income year. So just like talking about the previous client, if it goes from 200K to 400K, you're in a really high income year. This may be a strategy to balance that out. So then you can bunch all your charitable deductions, in your high income year, because they can roll. And so then you maximize that tax benefit. All right. Number 4, I'm sad because we're not going to get to the bonuses. I always jam pack. So forgive me. I'll try to make these kind of quick. One that, and this is maybe one that we'll make it quick on. So strategy number 4 is your qualified small business stock, or QSBS. And this is the closest thing to get out of taxes free card that I think exists in the tax code. So imagine that you are about to sell your business. You're going to sell it for 10 million, and you want to end up zeroing out your gain, your taxes that you would pay on the gain. That is what QSBS does. So if you let's say you had started a business 5 or 10 years ago, and last year you decided you were going to sell this business. The business is going to sell for 8 million. So with that, you would qualify for QSBS treatment. The way that that works is if you start a business and it has stock, you hold the stock in that business for at least 5 years, and you meet certain other requirements that are negligible, you can exclude up to 10 million in gains in your federal taxes when you sell. So again, remember the scenario I gave is only 8 million. So you can do the math. The 8 million that is sold for, and then under the QSBS, the entire 8 million becomes tax free. That means you saved about 2 million that you would have otherwise had to pay in taxes. And the requirements are really straightforward. I don't have many clients if I haven't set them up and they come to me from someone else, I don't have many that I get to use the strategy with that way, but getting them set up the right way and putting them on the right path, I have. So some of the requirements are you must be a C Corp. The stock has to be held for 5 years or more. The company has to actively be in business. So you can't like have a shell corporation or something, just have it a holding company that's not doing anything. And the company assets cannot be more than $50 million when you get the stock. And so this is really great for setting it up in the early stages of business to reap the benefits later. And so you can make this election when you start your business, but not when you can't wait until you get ready to sell it. So that's why I said people who come to me already started, I can't help them with this. But if you have a business that could grow significantly, consider maybe using a C Corp if your intention is to sell later, because this election will help you. And so does it mean that I said earlier that you want to consider an S Corp, and you do, but sometimes there's a reason you want to be a C Corp. And honestly, our tax code favors corporations because corporations are businesses that are creating jobs, and so that's why you end up getting massive tax breaks. Another one I have a few clients that are in real estate that use is the opportunity zone. Opportunity zone essentially, if you have property that you purchase, it's in a certain neighborhood or area that is designated as an opportunity zone, then you can invest capital gains. You can invest your capital gains in that area and get substantial benefit. So it's a really great way to reduce or defer your taxes that you would already owe, because let's say you hadn't planned well. And so you have to hold this property though for 10 years. But if you hold it for 10 years, let's say you bought it for 10,000 in opportunity zone and it ended up being 500K when you got ready to sell it, you're not going to get taxed on any of that appreciated value. So that means you get an immediate tax deduction. Well, not immediate, but 10 years. But if you sell it, let's say you couldn't wait 10 and you decided you could only hold out for 7. There's a small reduction of like 10 or 15% off of that. So you still don't pay taxes on majority. You only pay taxes on the that small amount. You want to hold it for 10 years. If you don't, and let's say you only get halfway, you still reap some of the benefits. So this is one that is very useful. All right, I'm gonna get you through to number 7, and I don't mind sending out a worksheet or just a checklist on the other ones if we don't make it, or if you all want to stay a little bit, we can. So the next strategy is number 6. That's family limited partnerships, FLPs. This is where wealthy families start thinking together collaboratively, but also legacy and generationally. So let me tell you about the Gray family. The Gray family had a successful business. It was up and running. It was worth about 5 million. And they wanted to start transferring wealth to their 3 kids without triggering any gift taxes. And then gift taxes are pretty high in a lot of states, and federally the bar is high but they made a lot and they are intending to make even more. So what we did was we created a FLP. We transferred the business into that. The parents were able to be general partners, which means they maintain control at 60% ownership of that. But then they gave the kids the other 40% and considered them as limited partners. The beautiful part of this and the magic of it all is because the kids' shares were minority interests and they had no control, their worth is less than 40% of the total business's value. So instead of being worth 2 million, then it might only be worth 1.4 million for gift tax purposes. Think of it like this. So would you rather pay full price for 40% of a business if you had no say in it? Probably not. So then the IRS recognizes that and they call it a minority discount. So because you're a minority business owner, you don't really get any say. They pity you and they're like, oh, we'll give you a break. So what the Grays were able to do was to transfer $2 million of value while only using 1.4 million of their lifetime gift tax exemption. So all future appreciation in the business ends up happening in the kids' hands, not necessarily in the parents'. And the FLP was used to be able to transfer the assets that were going to continue to appreciate in value, like the investment portfolios and real estate and things like that. So the key on why this works so well is to have the assets that if you have assets that are likely to gain value and appreciate over time. Now, don't try to go out. This is one of those times where it's the appendectomy or it's the root canal. It does take meticulous, careful planning and making sure that you are staying up on your compliance. This is not one that I say do it yourself. This is not a DIY. Families with significant wealth are able to use these powerful tools without getting in trouble and without fudging it up because they use experts, and I recommend that you do the same. All right. This one is one that I want you to remember it. You may not use it right now, but I want you to start thinking about your great-great-grandchildren. One of the things that the wealthy always do is they look out for future generations. They're looking to create a legacy and to have generational wealth and make sure that their kids and their kids' are set up nicely and that they're not paying taxes either. So their goal is to avoid paying gift taxes, estate taxes, all of that forever, right? So imagine that you're going to set up a financial structure today that could benefit the next 100 years of your family and would avoid estate taxes generation after generation after generation. That's exactly what this is. So with this, you set up a trust and the trust can last for multiple generations. You fund the trust with assets that are likely to gain value. So these are your stock, your real estate, your investment portfolios, your businesses, your business interests. And the trust then provides for your grandchildren, your children, your grandchildren, and much beyond. The magic is that these assets aren't considered part of anybody's estate as they pass from generation to generation. So they're just out there. That means you can skip estate taxes over and over because it's in a trust. No one particularly owns it. The trust holds the assets and the beneficiaries benefit from it. So dynasty trusts work really well in states that have favorable trust laws. Of course, these are ones that typically have favorable LLC laws. So like Delaware and Nevada and South Dakota. These states allow these kinds of trusts to exist forever into perpetuity, as long as they're maintained the way that they're supposed to be and the rules are followed of the trust documents and the federal laws. But they are really great for asset protection because, again, nobody technically owns the assets. You just get to benefit from them. So if you can combine the dynasty trust with some of the other strategies that we've talked about, then you might be able to, let's say, take your QSBS stock or your family partnership and put it into the dynasty trust. That using these strategies together amplifies the benefits and the tax benefits across generations. All right, so I'm gonna skip the other few. Here's the thing that I want you to take away. I know I've used big numbers on some of these, and I have some clients and even family members who are like, Nikki, I don't have a $10 million business. Well, you don't today, but the goal is to get there. You may not have that many zeros. You may not be part of the 2 comma club or whatever, but that doesn't mean that you cannot implement these strategies or plan knowing that these strategies exist. So when you're ready to implement them, you can. So just to recap, 7 strategies that we were able to go over, and the 2 that I skipped, I promise you, if you reach out, I can give it to you in a worksheet, are these: buy, borrow, die. That means never sell assets that can appreciate in value if you can borrow against them. 2, entrepreneurship, start a business, start it now. And when it makes 40 to 50K net, consider being an S Corp. Structure yourself as your business as an S Corp to save you thousands on what you would otherwise pay in self-employment taxes if you were an LLC or a regular corporation. Strategic charitable giving. Remember Charity and her dogs. Get smart while maximizing your deductions, but also making a difference in the community and putting money to causes that make sense to you and that you value. The QSBS, potentially, eliminating business sales, taxes on business sales of a business up to the 10 million. And I can't wait till I get to the day where I'm like, it stopped at 10 million. I needed 20. Opportunity zones where you can turn capital gains into community investments. And it doesn't have to, opportunity zones doesn't just have to be with real estate. You can actually start your business in an opportunity zone and get benefits. The family limited partnerships, an easy way to transfer wealth at discounted values while you're alive and if you have a business. And the dynasty trust, used to build generation after generation after generational wealth while avoiding tax liability and estate taxes every year. So that's 7 of what is in their secret playbook. Just remember, it isn't cheating. It's about understanding the rules. The wealthy are no smarter than you are. They just have better advisors and they know to start planning. So the real call to action and the key is to start now. Don't wait. Start educating yourself on as much as you can. So today was a great start, but don't stop there. And then start implementing these 7 strategies immediately or when you can. And if you can, just pick 1 or 2 to learn about today so that you can find how it may make sense for your situation now or later, but begin there. And I promise you, if you do that, your future you and the future generations will thank you for the knowledge that you gained today and what you actually did with it.
Awesome. Thanks so much, Nichole. And we will, I'll be sending out the recording. And then if you want to share that worksheet with me too, I can send that out to everyone.
Can you send it out to those who have registered? I didn't set it up to where it has a download, or I can give you all my email if that helps.
Sure, either way.
Okay, so the email, just so you can have it, is Nichole, and Nichole has an H, Nichole at Louisville, LOUISVILLKY law.com. And we say Louisville like you got something in your mouth, but it's Louisville. So Nichole at Louisville, LOUISVILLEKY for Kentucky, law, LAW, and that's where you can find me.
Okay. Awesome. Thanks so much, Nicole.
Thank you. You
And
all
we
have a
will,
great
yeah.
day.
All right, everyone have a great week. Take care. Bye.
Bye.